gave up managing billions to become a better investor. Episode 4. You ask lots of questions for a 30-year-old. Hello. I'm often asked about the elevator pitch, what you should be asking in investment about what will identify whether this is a fantastic investment, a smart sector to be involved with, or perhaps something to avoid. But the reality is, of course, is that there's never a single question, something that you can just say in 5 or 10 seconds that give you a brilliant insight into something. You just have to keep on working hard, keep on building up insights and everything in order to allow you to come to a conclusion. And of course, the investment game, it never ends. It never stops. Stock markets may shut now and again, but it never stops forever. And it's funny when I'm sort of talking to you about this because, again, on a previous podcast, and by the way, this is podcast episode number 4. So if you haven't listened to episodes 1, 2, and 3, please listen to those first because this will make an awful lot more sense if you do. I said on a previous episode that I had a sort of an interesting sort of learning experience in my very first job for company A. And I learned that I had to write stuff down. That was super important. But not only that, I needed to try to work out what questions I should keep on re-asking in order to get more insights. And it's funny because the real, if you like, inspiration for lots of those thoughts actually came from my second trip to New York. This was actually my first trip on business by myself, which is a little bit scary. In any case, at that moment in time, I was talking to lots of hedge fund managers, and it was kind of sort of a pressurized experience in the sense that these were guys who were busy, who were undoubtedly extremely smart, way smarter than me. And I didn't have much time, but I wanted to try to find out whether they were good investors, whether it was something that it was still sensible to invest in, whether they were making good choices or not. And I remember I was sitting with one guy, and after a few minutes and probably lots of questions from me, he said that infamous line, "You ask a lot of questions for a 30-year-old." And the funny thing about it, of course, was that I was 24 at the time. So I thought to myself, I either look much older than I am, or I'm actually doing an all right job in terms of asking some semi-tough questions to someone who's super experienced and probably has all the answers and even more. But actually, when I came back on the plane that evening, I remember writing down all of these rules and thoughts and everything else about the important role asking questions and keeping on asking questions meant for your investment process. And years later, when I worked for Company B and Company C, when I eventually became a fund manager, managed the billions and made, I guess, some good results and good conclusions, I'd learnt a little bit more about how to think about investments and how to make sure that you're suitably prepared. You may recall on the previous podcast, I talked a lot about valuation and my kind of observation, if you like, at the moment, that a lot of people focus just on the valuation angle, or it becomes a huge part of their report or their bit of analysis. And it's because, I guess, the way that investment is currently taught at universities or in a lot of books is that there's a lot of important valuation elements that you must go through in order to give you an idea whether this is a great investment or a terrible one, or something in the middle. Well, I think actually the reality is you should be starting off a lot more with the analytical work and kind of concluding really with the valuation stuff in order to understand whether this is an interesting investment or not. But the thing about the analytical research side is that I think there are 2 important elements to it. And again, I kind of feel that a lot of people don't always think about them. The first is the macro side. Now, I know you want to be a stock investor or even maybe a bond investor. You want to be thinking about the specifics about a particular company and maybe possibly the sector that it's in. Maybe you are an analyst and that is your job. You are an XYZ sector analyst, and therefore you look at that sector and a range of stocks. That's what you do. But the reality is everything is influenced by macroeconomic matters, and that might be inflation, interest rates, budgets, surpluses, ifs and buts, geopolitical whatevers, a range of things. And I guess, again, I was quite lucky in the early stages of my career when I was working particularly for Company A. I understood that this macro side hugely kind of impacted everything. Again, it probably helped that I had an economics A level. I did an economics undergraduate degree, but anybody can look at macroeconomics, and I guess everybody does. You know, if you watch the TV, read the newspapers, listen to what's on various other podcasts, it's all about macro. It seems to be a mega important thing in everyone's world, whether you vote or choose not to. But as an investor, it often gets sort of ignored in the sense that people say, right, well, the important thing is to find out whether this is a great sector or a great stock. Does it have good management, and whether the valuation work looks exciting? And they ignore the macro. They think, well, it's kind of boring. It has a sort of an impact. Yes, it might help markets go up or down, but it helps everything go up and everything go down. But reality is it's a lot more subtle than that. And I would say the important thing is to spend 25% of your time looking at macroeconomic matters. Now, I know some people may say, wow, you should be only spending 1% of your time looking at macro, or 10% of your time. Maybe others will say, hang on, everything kind of, they understand what I'm saying. Everything sort of is interlinked with macroeconomic issues. You should be spending a huge amount of time, 50, 80% of your time looking at it. But I think about 25% is about right. And by macro matters, really, you've got to be thinking about all those important things concerning politics and prices and interest rates and related, but also really how it interlinks with what you're spending your other 75% of your time doing. And that is, of course, the classic, and this is obviously now very, very well taught by books and courses and everything else, ways of looking the bottom-up analysis of a company and a sector, whether a set of results is telling you that something is interesting or not. And ultimately it manifests itself into the aforementioned valuation element of it too. But nevertheless, you still need to read about whether a company is, if revenue is growing or slowing, what margins are doing, what their other sort of insights are on their portfolio. Have they got a great balance sheet or a terrible balance sheet? And ultimately then how it's valued and whether it all makes sense or not. But it all kind of links together. And if you don't do the macro first, then I think you're going to struggle, because whilst the bottom up analyst will get some great insights into what a company is doing, why they are taking market share or losing market share or whatever it might be, unless you put it into macro context, you'll start wondering, well, does this ultimately really matter? What could tomorrow really bring or not offer for the company? And of course, the mention of tomorrow is, of course, another mega important aspect, because, of course, whilst it's really nice to look at a presented set of full year numbers and say, wow, this company is still cheap or it's now too expensive, based on your clever, close looked at numbers and valuations and everything else, investment markets always look forward, and you must always try and say, okay, given the macro backdrop that I see today and for tomorrow, and by tomorrow I mean the next year or 18 months, then I've got to say, well, what does that mean therefore for the margins, the revenues, the other influences on a company's set of financial numbers and general corporate progress, their market shares, whether they're going to make more profits or less profits, or more cash flow or less cash flow, or whatever it might be. And then that helps you put it all together in order to say whether this is a cheap company or not. I mentioned last time in my previous podcast that there were two sets of numbers that I really liked. And I want people to move away from PE ratios and start looking at EV/EBIT ratios. That's much more interesting to me. And again, it's probably one for another podcast where I talk about some specific company ideas or errors or maybe good judgments that I made historically, when I sort of said, wow, this is actually a cheap stock, whilst other stocks were perhaps expensive for various reasons. And of course, thinking about EV/EBIT ratios, it's quite sort of simplistic to say, wow, if it's a single digit EV/EBIT ratio, then it's cheap. And if it's sort of over 20 times or something, then it's expensive. And of course, it's trickier than that for two reasons. One is that you've got to consider, well, is this a company that is still growing, or perhaps it isn't growing anymore? And even more importantly, not just what it's doing today or how a set of numbers have appeared when you do your valuation work, after all your fundamental kind of analytical thoughts and everything else. what are the numbers going to be doing tomorrow and next year, and maybe even the year after that? And that's where it gets trickier. And this is why you need that sort of macro thought backdrop in order to enable you to say, well, should I be raising my margin hopes? Will revenue really be going up, or will it be going down? Will there be pressure on the business, or perhaps opportunities to make more money? And the same, of course, applies for free cash flow. As previously discussed, I kind of find that people kind of have ignored free cash flow for many years now, particularly during the 2010s when it didn't seem to matter so much. People could say, well, if a company isn't generating free cash or isn't paying a dividend, that doesn't matter because there's great growth or there's great prospects or enthusiasm for some perceived future. And of course, that may or may not happen over the next few years or not. What I observe today in a world where, a bit like what we saw in the 1980s or 1990s, even the early part of this century, is that return to an acknowledgement that balance sheets do matter a lot more than perhaps people thought. Whether you can generate free cash or not is starting to matter a lot more, because it not only means whether you can maybe pay a dividend or not, but also whether you've got sufficient cash flow in order to do everything else you need to do. After all, investment is not just about whether you can pay a dividend. It's all about the fact that you can reinvest into your business, into its future, which will have a big influence on whether an idea is truly a medium to longer term opportunity or whether it's just something for today or tomorrow. And that's where, again, you've got to be thinking about matters looking forward. It's not just about what you see today. It's about what you can perceive for tomorrow. And for that, you need both macro matters as well as sort of analytical elements to it. So as I say, think about your time as an investor as 25% macro and 75% sort of analytical from a sector and a company perspective. And if you split your time in that way, I think that would be probably maximize your chances of being a smart investor. And again, over following podcasts, we'll try and draw this all together a bit better in order to say, right, this is what I should be looking for. And again, there are 1,000,000,001 different examples in terms of different stocks, different sectors, companies in different countries and related. But if you can remember all the time that you've got to be thinking about macro as well as that bottom up sort of sector company kind of insights, then you'd be going a long way. So hopefully that's been kind of a useful insight. Again, I can talk about matters concerning the absolute level of where an EV/EBIT ratio ideally should be looking forward, and ditto whether free cash flow really matters in terms of whether it's a number of percent or whether it's just over 5% or maybe even nothing at all, and how you kind of factor that in. And again, in future podcasts, we'll talk about that, because again, the role of where a company is, what sector is it in, what prospects there are for it, all become a relevant point. But hopefully, again, that's been useful in terms of trying to pull together some of these early stage ideas and trying again to tell you that this is a world where I'm afraid you've got to keep on working. It's not an easy, there are lots of simple ideas. And if you apply those simple ideas, you will be an investment genius. It's not like that. And the world of fundamental investment analysis, it is hard work. And again, as I'm sure you've noticed, if you're into technical investing based on price movements and related alone, this is not really the right sort of podcast for you. This is a rather more boring, fundamental centered, how does it work, at least in my perception, at least on an investment analytical side. But more on that in future podcasts to come. But once again, I have told you so little, I feel, but once again, I must close now. So hopefully you enjoyed episode 4. The next episode is going to be titled Know Thyself. And again, as always with my podcast, it seems there's a slight story associated with that. So thanks again for listening, and bye-bye.